Good evening, friends. Welcome everyone for today's session on intra-group financial transactions. Continuing with our series on UNTP manual, chapter B.9, which is relating to intra-group financial transactions. There are two parts to it, friends, out of which we'll be taking first part today. Second part will be taken subsequently next week. Before starting, would like to acknowledge the effort of Gracelyn for preparing this presentation. The legends used pretty similar to what we have seen before, friends. The schema for the evening overview, practical importance of intra-group financial transactions, arm's length nature, delineation, and comparability analysis. This word delineation we have seen a lot in our earlier presentations also. Potential transfer pricing methods, applications of arm's length principle to intra-group loans, and the way forward. So generally, it's a common practice for MNEs friends to finance part of the operations through loans or to reduce cost for external funding. Because certainly, when a group is operating at an international level and there are various companies in various countries for that group, getting a loan or using a loan funds rather than the own funds becomes pretty common for them. And again, in getting the loan funds, if at all there are possibility of getting intra-company loans, that is within the group itself, if one entity can pay to another entity the loan, or at least if not loan but give the guarantee to the external third party, that is in case of any default there would be a guarantee given by us that we will make the payment, will make good the payment. So in this session, particular today's session, we'll be focusing on the financial transactions other than guarantees, because guarantees again requires a separate presentation or separate webinar altogether to discuss how transfer pricing to be done for those particular transactions. Concerns regarding intra-group. So what are the various concerns? First, the significance of financial transactions for M&E groups in terms of amount involved and frequency. The ease that an M&E group has in shifting debt to group companies and claim an interest deduction. Difficulty that tax administration face in determining the true character and characteristics of certain financial instruments. The concern that excessive interest deductions provide opportunity for tax-based erosion. For example, the concerns of thin capitalization, wherein an entity is a highly a debt-oriented entity, wherein the equity part in the debt equity ratio is very less. In such a scenario, it's a concern when these transactions or these intra-group financial transactions happen between the group companies. Practical importance of intra-group financial transaction. Common types of transactions are intra-group loans, financial guarantees by parent for third-party loans taken by subsidiaries, cash pooling, hybrid financing, derivatives, treasury services, example, factoring and forfeiting, netting arrangements, payment factories, commodity risk management, captive insurance, asset management, carbon trading. So apart from the first five, anything relating to a financing or relating to actionable claim can fall within the ambit of treasury services. So these are various types of intra-group financial transactions. Centralized treasury of an M&E group. Unlike in a decentralized format, centralized treasury has full control over the financial resources of the group, which offers scale benefits and financial cost savings for an M&E group. So generally, in a particular M&E group, there would be a centralized treasury fund kind of, which would take care of finances across the group, be it the parent company's own jurisdiction or other jurisdictions across the world. Treasury department operate in different types. First, there are three centers: cost centers, value-added centers, and profit centers. Um, Cost centers and value-added centers more are on service centers, and profit centers are like typical operating profits. So cost centers, they assist group company with routine services and arrange transactions on their behalf, but do not assume any risk of capital. Value-added centers, these are cost-saving centers and more risk tolerant than their cost center counterparts. On the contrary, profit centers actively manage the operational expenses. They will strive for maximizing profit of their own operations and assume the risk of capital. Generally, for typically for service centers like cost centers and value-added centers, method would be, a best method would be cup method, the plus method, or a TNMM based on cost, whereas in profit center, the spread between cost of funding and return on cash will be mainly allocated to the treasury department entity. Specifically what type of method, how it has to be, we'll see in subsequent slides, friends. The substance of these centralized activity has to be carefully reviewed for accurate delineation of the actual transaction to determine arm's length remuneration of services index. So what exactly is actual accurate delineation? So in for a given particular transaction, the relevant parties, how they are interacting, how they are behaving, uh, what is the synergy between both the companies, what if one does not function his part, what would be the ramifications or impact of that on the other group company. So accurate delineation of any transaction is paramount, not only for intra-group financial transaction. As I mentioned before, we have seen this kind of word for our other or earlier presentations as well, where we were talking about various other type of transactions. So this becomes very important, like basically the functional asset and risk analysis as to which entity is performing what, and how an entity is dependent on other entity, and what is the role of a particular entity in the entire gamut of transaction. That is what is accurate delineation of transaction. Arms and nature of intragroup financial transactions analysis. Considering there are different facets of debt financing, the analysis of arms and nature can arguably conduct from several perspectives. Um, First, it could be undertaken by accepting the transaction as an intercompany loan at face value until the facts and circumstances of the transaction that are available for review leads to a decision the transaction is commercially irrational. Alternatively, a second scenario is that analysis could be conducted from the perspective of determining whether the economically significant characteristics of transactions lead to the conclusion financial transaction sufficiently resembles an intercompany loan, or more resembles something other than an intercompany loan. So these two perspectives, firstly, it would be considered as a intercompany loan. So loan given at a face value, any financial transaction would be first regarded that if there are certain specific characteristics in that particular transaction, which is saying that yes, that particular transaction need not be regarded as an intercompany loan, then yes, the nature would differ. Both these what was say categorization would be only if the transactions are commercially rational. If the transactions are commercially irrational, financial transaction to be disregarded as intercompany loan for transfer pricing purposes. So generally, it would be an intercompany loan at face value. The transaction, any financial transaction, would be regarded as that. If the second perspective is the analysis could be conducted from the perspective of determining whether the economically significant characteristics leads to a conclusion that financial transaction sufficiently resemble. So first is the the facts and circumstances of the transaction. Second, the economically significant characteristics. If both these leads to intercompany loan or something other than intercompany loan, which is more or less similar to intercompany loan, only if it is a commercially rational transaction. If there is no commercial sense in that transaction, then it would be disregarded as intercompany loan for the purpose of transfer pricing purposes. In a third scenario, it is also examined whether it is possible to conclude that intercompany transaction in its entirely is not a loan, but part of it could be treated as a loan. So some part of it is a loan, some part may be an equity, which is regarded as partly intercompany loan. Thus, a financial transaction for TP purposes would be treated partly as loan, as I said, partly as loan and partly as something other than loan, such as contribution to equity. Or if at all it's a commercially irrational, the financial transaction may be disregarded as intercompany loan. So, any financial transaction, if it is commercially irrational, then it would not be regarded as financial transaction or as an intercompany loan for the purpose of transfer pricing. So for the purpose of transfer pricing, any financial transaction has to be a commercially rational transaction for it to fall within the ambit of TP and accordingly applying the method. So this is very important, friends. If there is no commercial sense or it is not rationally correct, the transaction, we may not even take it for the purpose of transfer pricing study. So this is what something which is there in given in the UNTP manual. Yes, this kind of scenario does not exist in our Indian context, wherein we say or there are no specific exclusions if the transactions are commercially irrational. So we need to see when we would come to this stage wherein, like, if we can say if a transaction is commercially irrational in India, that any entity in India has done any transaction, any intercompany or financial transaction with the associated enterprise outside India, if there is no commercial sense, that transaction itself would not be regarded as financial transaction for the purpose of transfer pricing. In all the three scenarios mentioned above, the treatment of transaction as something other than a loan would for tax purpose lead to a limitation in the deductibility of interest. And again, the conclusion and the decision to characterize the transaction between A, that is presented as intercompany loan, requires careful analysis and should be based on educated information, as the company like this is likely to lead to double taxation. So a transaction, whether it's an intercompany loan, if not intercompany loan, something more than intercompany loan, which resembles some characteristics of intercompany loan, or third option is partly loan, partly equity. But while doing that, we need to take due care, wherein when we are doing a bifurcation, that out of this total part, some component is loan, some component is equity. We do not do that. There may be instances of double taxation. Delineation and comparability analysis. Significant characters for TP and benchmarking purposes for a financial transaction. Contractual terms, again, those are paramount. Like, what are the terms which are agreed between the A and R company for doing this financial transaction? Functional analysis in the entire gamut of transaction. Which entity will perform what functions? Again, characteristics of financial products or services. What exactly it is, as we have seen from, there are various types of financial transaction, whether it's a cash pooling or a hybrid transaction or a guarantee or a pure loan, what it is. Many groups global financing policy. So what exactly is the group's policy with regard to finance? So if, say, there is a policy for devised by the group stating that the between two companies of the group, there can be transaction of a financial transaction worth 100 crores. So whether our transaction is falling within that M&E group policy, that becomes paramount, because group has stated 100 crores, and what if there are transactions of more than 100 crores? So it may be questioned why there was a requirement. So what exactly is the group's policy, group's financing policy? That becomes paramount. Economic circumstances of the party, why that transactions is being entered, why there is a need for a person to lend money, and for a company to, or for a company to lend money, and for a company to get money. What is the requirement? Or what is the requirement for taking guarantee? What is the requirement for hybrid transaction, derivative transaction, or cash pooling? So what is the economic characteristics of that particular transaction? Again, consideration of the credit worthiness of A. So again, credit worthiness is important, friends. If, see, why this becomes paramount, friends, because if there is no credit worthiness of a company who is lending the loan, then there is no requirement, or the transaction itself would not be justified to confirm that it has happened at arm's length. Say, for example, we'll give an example. Say there is an A whose creditworthiness is not that great, and there is another company in India. So A is in, say, for example, Spain, and Indian company. If the Spain company's creditworthiness is not there, or say through some rating they have got some rating of, say, BBB minus, or again below that, there is no creditworthiness, and still there is a transaction of a loan, it may be considered as a sham transaction. That is, we are doing this transaction only for the purpose of getting excess interest deduction, or for the purpose of shifting our profits. So again, in this scenario, creditworthiness of A, creditworthiness of the company who is lending loan becomes very important. If there is no creditworthiness, the fundamental of that particular transaction would be questioned. Consideration of risk embedded into the financial transaction, financial instruments. Say, for example, there's an A company A, there's an A company B. Credit rating of A company B is triple B for loan 1, 2, 3, 4. There's an intercompany loan. So A has given loan to A company B. The status of the loan for between company A and B in essence is lower than that of the other three loans. So status meaning the credit rating. So maybe like if lender company A will only be entitled to claim repayment from company B in case of company's B bankruptcy after the latter has repaid the other three different loans. It holds a subordinate loan instrument with a higher risk. So for example, if there is a good repayment track for loan 1, 2, 3 for company B, but there is a default in loan 4. The credit rating of BBB may shift to BBB minus or say a down. So there has to be a downgrading of the credit rating when there are subsequent defaults. So if the track record is good for loan 1, 2, 3, the credit rating of triple B would be maintained or would be justified. But in case there are some concerns or say company B has filed bankruptcy and still that loan 4 is there and 1, 2, 3 has been repaid properly, but loan 4 still exists, then in such a scenario there has to be a downgrading which needs to be done. Delineation of the financial transaction. Consider the arm's length nature of the transaction as structured by the A. What exactly is delineation? A bit more expanded version of what I said before. Examine the conduct of the parties and base the analysis of the financial transaction. If pricing of transaction is not at arm's length or the transaction is to be characterized differently, arm's length principle to be applied. What exactly it is, we'll see in the subsequent slide. After doing accurate delineation, appropriate transfer pricing method should be applied. So this is what is the stage of how to accurately delineate a financial transaction. Consider the arm's length nature, examine the conduct of the parties and base the financial analysis of financial transaction. If the pricing is not at arm's length principle to be applied, and then after doing this accurate delineation, applying the most specific method or most appropriate method for justifying the transaction. Potential transfer pricing methods. Generally, there are like cup method in case of intra-group loan. Treasury services for M&E group, CPM or cost-based becomes more relevant, or CPM or cost-based TNMM becomes more relevant. Global trading or certain cash pooling transaction profit split method. So these are like typically used. So intra-company, intra-group loan, better cup method. If there are treasury services functions performed by M&E group, CPM or a cost-based TNMM would be better. In case there are transactions of cash pooling, transactional profit split, because everyone's money would be pulled into one account, so it's better transactional profit split method is used, because that also functions on the same principle that for a particular transaction there are more than two entities contributing, and we need to uh, give the contribution or value to that particular function. Safe harbors, again, as per Indian law for safe harbor, advancing of intra-group loan denominated in INR. So this is one of the transaction in Indian context of safe harbor. In the safe harbor, what it says, the interest rate declared is not less than the 1 year marginal cost of funds lending rate of SBI as on 1st April of relevant previous year plus. So whatever is the 1 year marginal cost of funding lending rate, first funds lending rate of SBI of that particular previous year as on 1st April, it should plus the allowable basis point, that is 175 in case of CRISIL credit rating of A is triple A to A or its equivalent, 325 BBB minus triple B or BBB plus or its equivalent, 475 general basis points are 4. When you say 475, it has to be 4.75 in case of credit rating of BB to B or its equivalent, 6.25 in case of C to D or its equivalent, 4.25 credit rating of A not available, an amount of loan advanced to A and all A's in INR does not exceed rupees 100 crore in the aggregate as of 31st March 20. So these safe harbor rules are for 2021. Friends, again I'll repeat, it should not be less than bracket the SBI lending rate for 1 year as of 1st April of the relevant previous year plus 1.75, 3.25, 4.75, 6.25 or 4.25 as the case may be, depending on the credit rating of AA. It cannot be less than these two components. Again, advancing of intra-group. So this was, friends, intra-group loan denominated in INR. Now let us say intra-group loan denominated in foreign currency. It should not be less than 6 month LIBOR rate. LIBOR is a London interbank offer rate of the relevant foreign currency as of 30th September of relevant previous year plus 1.5 the credit rating agency credit rating of CRISIL of that particular is triple A to A or its equivalent. 3 in case of triple B minus, triple B or triple B plus. 4.5 double B to B or its equivalent. 6 C to D or its equivalent. 400 again similar as we have seen. If the transaction does not 100 crores and credit rating of A is not available. For guarantee transaction for amount not exceeding rupees 100 crore or where it exceeds credit rating of A is of highest safety as done by SSEBI registered agency. The commission of fee declared in relation is at the rate not less than 1% annum of the amount guaranteed. 1% is the safe harbor rate in case the amount of loan for which guarantee is given is not exceeding 100 crores and the credit rating is of highest rating. Application of arm's length principle to intra-group loans. Type of intra-group loans, term loan and revolving loan or revolving credit facility. When analyzing an intra-group loan, relevant categories that may be considered including conversion right, currency guarantees, interest payment, options, repayment clauses, security provided, seniority and terms of loan needs to be considered. Determination of arm's length nature of intra-group loan would involve consideration of economically significant characteristics of the intra-group loan as discussed precisely for any intra-group financial transaction. Internal cup method or external cup method can be used as we have seen friends. Intra-group loans generally it's better like say you are taking loan at for example 9% from your AE, say 50 crores of loan. So if not going by safe harbor, if your bank in India, you being the Indian company and taking loan at 9% from A, your bank in India is offering say 10% and your A is offering at 9%. That is what the cup is would be used and we can justify the transaction. That would be an internal cup. External cup, say you are not availing any loan from any bankers. But generally on the SBI side, if you see the lending rate is say 10% or 10.5%, for example, for your kind of term loan for the similar quantum, that can be used as a cup, and that would be regarded as external cup method. So, in tips in terms of intra-group loans, generally cup method is the point of consideration in case of computing arm's length interest rate. Other relevant information which are mandatory is the use of credit default swaps to reflect the credit risk linked. Arm's length pricing of intra-group loans may also involve the evaluation of fees. Sorry, evaluation of fees and other charges in relating to intra-group loans. Additionally, associated with may not incur charges similar to those of independent lenders would in the process of raising capital and satisfying regulatory requirements. So, for example, if you're approaching any bank, bank may charge us processing fees and insurance needs to be taken, and some banks may also say to take shares of their particular banks. These requirements may not come in case when you are availing the same type of loan from A. So these needs to be factored while computing arm's length interest rate. So I'll just give an example. Say for example, you are availing a loan facility from your A at 9%. Similar example, but bankers are offering at the rate of say 8.75. Now someone may say like why you are paying 0.25% extra, but there is a justification or justification needs to be given that 0.25 I am paying extra, but because firstly it's an A, my own group company. Secondly, there are no processing charges, there is no insurance which I need to take, or there are no other hidden charges, or there are no shares which I need to take for getting this loan. And again, it's formality wise also I need not wait for any much formalities except for the regulatory point of view of FEMA and RBI. Apart from that, nothing much has to be done. So even though I'm paying 0.25 more, but there is a rationale for paying that extra amount or that extra percentage of interest, which can be justified. Yes, but again, the difference we need to quantify that and we need to justify the difference. Having said that, again, the difference can't be the bankers are the A is offering at 9 and the bankers here at are offering at say 6.5 and 7. That would be too difficult to justify. So, some deviation, yes, while calculating the arm's length rate, these factors needs to be considered. Way forward, so friends, It is noted that OECD has, under its mandate, released for the first time TP guidance on financial transactions in February 2022. There is a separate guidance for transfer pricing in case of financial transactions, which is released by OECD. This is, we are talking about UNTP manual, but OECD also has released. Again, OECD guidance encompass principles of delineation, where whatever be the transaction or the type of financial transaction, accurate delineation, that is like the functional analysis, or how a particular party is responding to another party, what will happen if a particular party may not perform their functions. So the importance of that particular party in the entire gamut of transactions. So that analysis needs to be done for any type of financial transactions. Then, if that is being done, doing a transfer pricing or justifying the arm's length rate would be easier, or would be simple once that exercise of accurate delineation is done. So these are some of the thoughts, friends, on the financial transactions apart from guarantee. Next week we'll be focusing on more specifically on the guarantee transactions. Thank you, and any questions would be happy to answer. Thank you, friends. Have a great evening.